Hello, everyone, and welcome to the 4 o'clock p.m. panel discussion at Crypto Connection 2021. Our panel discussion today, the last of the day, will focus on crypto legislation and regulation. Specifically, we are calling this panel Hot or Not? What is trending on crypto legislation and regulation? As I said, this is the last panel of today, June 8th, but it is by no means the last time that you can spend with your colleagues today. Immediately after this session, there will be a number of networking rooms available where you can join your colleagues, peers, and other attendees and our sponsors in one of the networking rooms. So the discussion is not at all over when we conclude here today. Instead, it's just beginning, and we encourage each of you to attend the networking rooms and enjoy some informal discussions with other members of the industry. So as I said, I'd like to jump right in. We have about an hour to cover a lot of topics, one very near and dear to me, as well as to everyone on the panel. So I want to jump in and get going right away. I would, before I do that, I'm going to introduce you briefly to our panelists. First, we have Roger Brown, the Global Head of Tax and Regulatory Affairs at Lukka. We have Aqsa Zubair, the FinTech regulator from the Bermuda Monetary Authority. We also have with us Alan Konevsky, the Chief Legal Officer of tZERO. And finally, we have Shivon Kershaw, the Senior Innovation and Education Advisor for LabCFTC. And my name is Harris Kay. I'm the Managing Partner of the Chicago office of Murphy and McGonigle. We are a law firm that assists our financial services industry clients in connection with navigating the complex web of regulatory issues associated with being in this business and in the financial services industry. So once again, welcome. And I want to jump right in here. Shivon, I think one of the questions that's in everyone's mind as we have switched over to a new administration as of this year is the regulation of cryptocurrencies. That's why we're all here. And so it appears to me that the new administration, and with it your agency, it intends to make the robust and fair regulation of cryptocurrencies a priority. Can you please tell us and tell the group what LabCFTC sees as an ideal regulatory environment and what LabCFTC is doing in order to achieve those goals?
Yeah, thank you, Harris. I first want to say I'm grateful for the invitation from the Global Digital Asset and Cryptocurrency Association for their invitation for me to speak today. And of note, my comments this afternoon are my own and not that of my commission or commissioners. In terms of an ideal regulatory environment, I'm encouraged. Right. I believe, and probably my fellow panelists would agree, that it's reassuring that the new administration has a laser focus on really making digital assets and crypto accessible and safe for all Americans. And if there's anything the colonial pipeline attacks have taught us, it's that an understanding of both crypto and cybercrime are critical for governments to understand and really fully comprehend in order for them to mitigate manipulations. So overall, we're off to a great demonstration of progress. But in order to live out an ideal regulatory environment, we really have to start with a proactive approach. And from the LabCFTC perspective, agencies, both large and small, really have to look at pairing education and engagement at the top of its priorities. That really means just actively meeting, collaborating, and learning from innovators to understand the path forward in fintech. Even this morning, we were seeing trending on Twitter, this going hand-in-hand collaboration from the Swiss-Danish group on their release of Global Transaction Unit crypto. And that offers some regulatory readiness in case of court-mandated circumstances, right? And it's the reason that LabCFTC focuses so heavily on intentional connections with fintechs and startups. We've successfully hosted FinTech Forward global conferences, Empire Innovation conferences, convening innovators, regulators, academics, all for the purpose of facilitating problem-solving dialogue. And we pride ourselves on hosting these weekly office hours where we've met with individually with over 300 fintechs. over the last few years. And really, we're offering firms the support that they require to kind of navigate the financial regulatory system while asking these like thought-provoking questions to offer a compliance perspective. And so we formed internal working groups, we've published educational primers, we even developed an innovation competition. And it's all for the same goal, so that we can move towards that ideal regulatory environment. And we're coordinating with associations, much like today, as well as state regulators as well. And it's been our priority to connect with key stakeholders in the room to address the needs of the market. And in my opinion, that's really what sets the tone for an ideal environment.
And that's great. And I know the industry is excited for the opportunity to really be on the cutting edge to work with the regulators in connection with achieving some of these goals and finding that right balance. So I want to call on a couple of members of the industry. Alan, can you talk to us about what you see and what the industry sees as goals to ensure robust and fair regulation, particularly given the borderless nature of cryptocurrencies, so that we can encourage this regulation, fair regulation that works for the industry, but also not to encourage a departure to less regulated or differently regulated jurisdictions?
Yeah, absolutely. Thank you very much. And delighted to be here this afternoon. I want to pick up on a couple of, super astute themes that Shivon worked into her remarks. I think as an industry, particularly those of us who've been at it for a while, we're all very enthusiastic around the secular shift in recognition of the benefits of digital technology and blockchain as the next set of rails to power value movement, whether it's securities, whether it's commodities, whether it's money, whether it's other assets in digital form, in the way that's quicker, faster, cheaper, more inclusive, with fewer frictions and intermediation. And part of the recognition of that, we think, eventuality is also increased positive attention that we've seen from the regulators, particularly in the United States, around how this technology can support, for example, the securities markets. And we've seen very important initiatives come out towards the end of last year from the Securities and Exchange Commission that provides paths for broker dealers to support digital asset securities in a very meaningful way. As we work towards that path, we need a regulatory climate that allows us to have a positive product-focused conversation that operates on the basis of predictability and stability. Any venture requires a significant amount of investment. In this case, in particular, I think between technology and lawyers, it's a toss-up as to what's the number one capex. But it's important, and I think as participants, particularly responsible participants, seek to leverage the benefit of a single technology layer that supports digitally native assets using distributed infrastructure as the ecosystem for value movement. We need to have predictability. And I think regulation that is driven by reactions to fringe behavior, so regulation by enforcement, provides some lessons and some takeaways, but it also preserves a fair amount of ambiguity that as you're looking to plan and design products that benefit the market, benefit the consumer, benefit the society using this new technology, you are left at a loss. And so something that leads to some folks staying away, other folks engaging in activity by trial and error, which again, perpetuates the cycle of poor choices and further uncertainty and enforcement activities. So we think that continuing down the path of proactive, positive guidance is absolutely critical to the industry having a product-focused conversation as opposed to continuing to iterate internally on regulatory uncertainties and technology, but in this sort of closed loop environment because folks aren't really sure on how broad of a wish list they can have from a product design perspective because they're not certain about the regulatory boundaries of what's permissible and what's not permissible. You know, from a global perspective, that the part of your question, I think that's absolutely right. It's, you know, under the best of circumstances, it's very difficult in this economy to silo away risks from different choices that are made by jurisdictions outside of the United States. With an environment that is powered by decentralized technology ecosystem, it becomes very, very difficult to silo that away. So absent a prohibition on certain activities, which I think we can all get behind the idea that that's not in the interest of driving innovation and adoption of this technology, you are exposing the market to the collateral consequences of offshore activity unless you create a positive, constructive environment domestically that allows those activities to happen in your home market. And so that's a critical element. I'm less worried about folks fleeing offshore. That happens, will continue to happen. But I think this journey is very much premised on, although we talk about decentralization and flattening of the ecosystem and reduction of the number of intermediaries and other participants as technology becomes a more efficient actor in these functions. But as we do, there's an end state and then there's a journey. And I think as we are on this journey, we require institutional participation. We require institutional adoption. And I think that the kinds of institutions that we need to support us, including institutions in the banking and the financial services sectors, are not going to be looking to flee to other jurisdictions and will most likely sit on the sidelines unless there is a positive, constructive environment here.
Very good. And I apologize. I had a bit of technical difficulties, but I am back. And I'd like to call on Roger, if I could, next to speak to a bit of the regulatory issues that you and Lukka see in connection with that.
Happy to. In essence, you want economic capital to flow where it's most efficiently utilized, where the resources are, where the talent exists to deploy, develop technology, and the like. And if you have regulation that stifles that, it's not going to flow there. It's going to flow where, quite frankly, there's the least amount of regulatory constraints, and therefore may not be a place where most of the resources or talent is to exploit the capital value. Divide things into four key areas. I know we're a bit behind in our time schedule, so that's going to be brief. The first category is raising capital. How do you have a robust regime with the SEC and Safe Harbor to make an effective relevant desire capital holders and hire and deploy engineers, software programmers, et cetera, to develop that? The United States, for example, London, Singapore, whatever, should create a regime that's certain kind of create that. Second is regulating exchanges, creating governance that when one trades on an exchange, there's the appropriate controls of things like flash sale trades are not happening, distort pricing, there's no fees, et cetera. There's transparency in the marketplace. that bad actors or people who do things with digital assets are isolated from those who seek to really interact for the commercial value and the commercial use cases, and separate those from those who would know the bad name. And the fourth category is writing tax rules. Commercial activity thrives when there's clear rules that the industry participants generally view. And people get the notion that there needs to be, people need to pay tax on gain. There's no asset class that broadly is exempt from tax, and crypto is no different than that. So the tax rules shouldn't create unnecessary risk because there's just lack of guidance in certain areas, such as staking, lending, DeFi protocols, etc. Then classifying digital assets, what are they? Commodities, capital assets, big collectibles, the ordinary or something else. And that's how, in effect, you create, I think, a fair, robust regulation that promotes innovation in any domestic market.
Very good. And I do want to speak to the regulators about this, particularly on that the offshore issue. But first, I want to bring it back to Shivon briefly, if I could. Shivon, to the extent that crypto businesses are now or may be located offshore, or they may move there as they consider some of the issues associated with regulations in the United States. What plans does LabCFTC may have to work with other regulators across the globe to make sure there is some consistency associated with that regulation, and to make sure that all the regulators have a hand in discussing what the issues are that may be facing crypto companies?
Absolutely. In terms of joint effort, we're several years in the making with relationships in the UK and Singapore and South Africa and Canada and the Bahamas and Australia, just to name a few, where we formalize cooperative agreements to conduct regular touch points as a forum for joint RegTech. And really, what we're working to do is to promote knowledge sharing across these platforms that really facilitate solutions through cross-border trials. So as one specific example, LabCFTC helped lead the efforts for the Commission to join GFIN, which is the Global Financial Innovation Network, where the CFTC, along with SEC, CFPB, FDIC, and really over 60 organizations committed to supporting financial innovation in the interests of consumers. And it's through this cross-border collaboration that we can zoom in on opportunities for sandboxing, for tech sprints. We're able to model our regulatory reporting and enhance our surveillance efforts and really double down on AML and financial crime by discussing the tactics and the strategies, but also by discussing the trends that we're seeing. And during the pandemic alone, we met monthly with these governments to discuss and audit our virtual currency crimes and scams. But we also looked at the techniques and the technology from our own toolkits with our counterparts of these countries to really improve the overall effectiveness for the regulator.
Very good. And let's hear from one of those other regulators. Aqsa, I know we're very excited to have you here, and I would love to hear from you on this, of course, as would our group. Now, to the extent that crypto businesses may be located, or rather as the regulations develop and the cryptocurrency businesses are located offshore, and as we see these regulations develop, what do you define as a crypto-friendly approach to regulation?
Great. Thank you for the question, Harris. And thank you for having me on this panel. Being crypto-friendly from a regulator's perspective is largely about evolving to meet the needs of digital transformation that's actually happening in the market, but also balancing that with our remit as a regulator, which involves protecting consumers, ensuring financial stability, and preventing financial crime. It's about creating a safe space for disruption and innovation. And it's also about accepting that as regulators and the market, we need to remain agile and keep pace with whatever direction the market's moving. So in the past 5 years, the BMA has been a vivid example of crypto-friendly. So earlier on, we saw the need for regulations, and instead of trying to fit this industry into pre-existing regulations, we developed a bespoke digital asset regulatory framework to cater to the market, but also to maintain the high risk standards of the jurisdiction, particularly as those that apply to the AML ATF sector. That framework included a sandbox to allow companies to test and build, but also to further develop their compliance programs with enhanced regulatory supervision. We want companies to grow with a compliance mindset and have compliance built right into their code, because we understand that the cost of non-compliance can be significantly greater down the road. The sandbox approach has been pretty successful so far. We've built on that success to allow for an intermediary class of license to be introduced, such that companies are moving through a graduated approach throughout our license classes and are able to kind of transform with us. I think a key factor of our regulations is really around remaining distinct and crypto friendly, is that we are ever evolving and we have largely iterative regulations. We consult with the market participants and ensure that the framework remains fit for purpose and conducive to innovation, right? So we want to make sure that we're taking a principles-based approach and that provides the right flexibility to adequately protect consumers, but then welcome financial innovation, particularly models that we haven't actually seen before. So since the launch of our regs, we've amended them a few times already. We've included a new licensable class. We've included new activities. We also introduced the Digital Asset Issuance Act, such that we regulate the full spectrum of digital assets in Bermuda, so issuances and businesses. And since our launch in 2018, we've issued about 10 licenses to digital asset businesses across a variety of categories. But our role kind of extends well beyond our registrants, right? So we've met with a significant number of companies and stakeholders and regulators, as Shivon has mentioned, around that ecosystem. And our discussions kind of confirm that there is a need and push for more legal and regulatory certainty in the sector, both from a financial institutions perspective, but also from a consumer perspective. And I guess just bringing it back to that question of crypto friendly, we need to look at the entire set of stakeholders in the ecosystem to build something that's sustainable and that actually benefits society.
Great, thank you. Thank you for that. And I know we're going to come back on some of these cross-border issues, and we've got some more time, so I intend to get to those soon. Roger, I'd like to turn now to kind of the more specific, if I could. We've talked about some general regulatory issues. Let's talk about your thoughts about the tax issues associated with some of these cross-border regulatory matters and transactions. And I know you have some thoughts on the state of appropriate taxing of cryptocurrency assets in the first place. I'd love to hear from you on that.
Happy to. Just before I start, can you hear my mic? Is it okay? Great. So with that, there's a big gap between the transactions that occur in the ecosystem and the guidance that's been published to date. You can't find a reference anywhere in the tax code to crypto. It just doesn't exist. It doesn't mean there are no rules. In fact, you have to apply the many tax rules that exist in the code, case law, and regulations, and then determine your tax result by looking to what is the most analogous item. A rule may treat some crypto as a commodity, but not other crypto. A rule may treat some crypto as a collectible and apply those rules and not other. And sometimes certain crypto could be a currency, quite frankly, and dealing with all the rules that apply there. So you have to deal with the relevant rule, and sometimes there's overlap between what other agencies do, like the CFTC, because the tax rule bases its application on what another agency does. I'm not sure if many times the regulator knows that, but that's the way in many instances the tax rules treat their relevant asset. There are no rules around the diversity of transactions that occur in the ecosystem, such as mining, staking, lending, forks, slashing. So what does one do? You have to find the analog in the code and the regulations to see what you're going to do and apply it. The problem is tax advice can be very expensive and cumbersome and time consuming. And it even gets more expensive if you have to teach your tax advisor about the technology in the ecosystem before you can get an answer about the relevant tax rule. And when you get to cross-border activity, it's even more complex because there isn't harmonization around how crypto is taxed. And some countries have published guidance, many don't. But it is interesting to study the differences because a common theme throughout is that countries tend to look to some relevant economic activity they can point to in the ecosystem and say, is that the right starting point? And is it the right ending point? And labels don't govern, quite frankly. Many people call crypto interest. but I'm not aware of any tax authorities that treat it as interest from a tax perspective, which then has a number of follow-on consequences. So it just goes back to the point that there are few tax rules on the relevant transactions that occur. Most of them are non-binding. You have to apply some general rule that leads you to a result. And in many cases, there's uncertainty, and uncertainty can act as dimming economic behavior.
Thank you. And Alan, I want to turn back to you briefly. We heard from the regulators on what they see as an effective set of robust, fair regulation, et cetera. You spoke to it. Is there anything that's particularly on your wish list now that we have us all together that you'd like to see a particular focus on? I know you spoke about some of your goals and your concerns, but is there something we haven't covered, something that you'd really like to see as we move forward here?
No, that's a great question. Thank you. I'll pick out three topics. I mean, obviously, when you look at digital asset space generally, and then you look at the point of creation of interests, secondary trading or exchange of interests, compliance features, including anti-money laundering and KYC type topics that other panelists have talked about, tax that Roger spoke about eloquently. There are a lot of issues. I'll pick three. One is going back to the definitional question of, and it's in particular relevant to the question of, is it a security or is it not a security? Although it's also relevant to the question, is it a commodity or not a commodity? But particularly from a perspective of digital asset securities, is it a security or is it not a security? And the fallback, kind of the Howey case is publicly available and was decided in 1946. And the principles enumerated in the Howey test, which are qualitative in nature and subject to interpretation and have been interpreted by the courts and regulatory agencies since the case was decided, particularly around what constitutes an investment contract and therefore could be a security, is a topic that's in need of guidance. We saw the market in 2016, 2017, early 2018 with some of the early initial coin offerings run into issues with people misinterpreting, misunderstanding, failing to understand, or doing the best they can with the guidance as to what is security and what is not a security, and therefore offering instruments in the way that is or isn't compliant with federal securities laws, and trading them in a way that is or isn't compliant with federal securities laws. And that pattern has been replaying itself now with non-fungible tokens. So the push for digitization of collectibles and other assets. And again, some of the concerns around, are there features that make these interests economically attractive, like fractionalized ownership and distribution of economic rights, that probably make them an investment contract and therefore under the Howey test and therefore a security. And so that topic remains. There have been conversations recently about providing more guidance. I think SEC Commissioner Peirce talked about that, and that's something that we'd love to see, because again, from perspective of providing positive guidance so people can allocate capital, make decisions, and undertake activities that are compliant from day one, that's a critical question. It's a critical question for the traditional crypto community, because it answers, well, what exactly do I have to do to undertake a distributed project that won't be a security? And Commissioner Peirce came out with a proposal on that topic. It also goes to some of these other assets like NFTs. So that's important. I'll speed up. I think the second topic is, and it goes back to a set of rules that the SEC put out last year, is stopping some of the pressure to balkanize activities. By that, I mean, there's a particular kind of a broker-dealer that can touch digital asset securities and another kind of broker-dealer that can touch other securities, and a money services business that can touch cryptocurrencies, and eBay that can touch non-security, non-commodity NFTs, and the ability to bring access to digital assets under one platform, a combined user experience that allows investors and consumers to access crypto and other digital asset related products through more than a number of wallets and interfaces and brokerage accounts and other accounts is important. And so I think the proposal that the Securities and Exchange Commission came out around special purpose broker dealers has been phenomenally innovative and welcomed by the industry. And we and others have provided our feedback to the staff of the commission. But one of the topics we'd love to have more conversation on is allowing existing market participants to do more with digital assets, to do more with digital asset securities, to do more with crypto, including broker dealers. That's item number 2. And item number 3, and this is kind of a more watch this space, although it does link to the topic about cross-border impacts, is trading of cryptocurrencies. And there's been a lot of conversations, including from SEC Chair Gensler and other participants on introducing additional framework, whether that's new legislation or something else. And some of these instruments might very well be securities and already have a framework within which they belong. But to the extent they're neither securities nor commodities and the different types of instruments, introducing a new framework that provides some regulatory context for trading of these types of digital assets, for these types of cryptocurrencies, and in particular to insulate the U.S. market from some of the actual or perceived impacts of trading activity that occurs offshore and can be subject to various inefficiencies and other actions, whether accidental or intentional, that impact prices. So, and again, look, there are a lot of market participants in the U.S. that have great experience with operating regulated trading venues, whether in the security space or outside of the security space. And so we would, very much welcome a conversation with the industry on how that can be structured.
Very good, very good. So Aqsa, with all that we've talked about and all that's up in the air and all these cross-border issues and the borderless nature of crypto and trying to, assemble a set of rules that apply at least as uniformly as possible, how is the BMA adapting to this, given that borderless nature? What are you doing in order to kind of get yourself ready for that, as well as to welcome that kind of business in Bermuda?
Yeah, thank you for the question. I think the borderless characteristic of crypto has largely been perceived as a market opportunity, and in many ways, an effort to create more of a borderless global community. And we've seen the benefits of that, especially in the post-COVID era, right? And there are many benefits to this. However, as one can imagine, and I think my co-panelists will agree, is that it's slightly challenging for the regulators. So a central pillar to all sectors of financial services is cross-border collaboration. So the BMA's approach to this is really twofold. First, we actively participate with international organizations. For example, we maintain an active membership with the International Organization of Securities Commissions, so the IOSCO, and their fintech network, as well as GFIN, as was mentioned by my co-panelist Shivon earlier. The latter is comprised of 60 regulatory organizations around the world aimed at supporting financial innovation in the interest of consumers, increasing cross-border collaboration, and creating that network of regulators that can seek to discuss on topics important to each of our jurisdictions. Within GFIN, for example, we're also an active member of the cross-border testing workstream, which acts as a global sandbox for firms looking to scale their innovations, apply to various jurisdictions in a seamless manner, and then also be jointly supervised by these regulators. We're very much requiring cross-border collaboration from regulators, right? So that needs to happen in order for that sandbox to succeed. The second thing we do is we zero in on joint efforts with other jurisdictions. So we've recently signed a digital asset MOU with the Wyoming Division of Banking. So this MOU creates a framework under which the BMA and the WDOB can cooperate to facilitate the establishment of digital asset entities across our jurisdictions and actually have effective supervision. The framework includes supervisory cooperation, mutual assistance, as well as the exchange of information. It also extends to further areas of cooperation, right? So this can include, joint office hours that we would take with the market, workshops and other discussions with digital asset businesses, publications and media content, as well as staff exchanges and joint meetings. So it would be interesting if we send someone from the BMA and transplant them in Wyoming and kind of see the learnings that would come out of that. And finally, I should point out that while entities are licensed under a regulatory framework in Bermuda, and they may deal from within Bermuda to a global scale, they're still responsible for complying with the sanctions and all applicable local or foreign regulations that will be in place. They do have that onus on them.
Thank you. Thank you. Shivon, I want to turn to you, if I may. And because we have such a wide, varied audience here, I'd like to hear from you with regard to some of the smaller firms, some of the more firms that might be focused on, as opposed to the financial services aspects of this and the clearing aspects, et cetera, more the cutting edge of the technology with respect to this new industry. What do you see as the regulatory role in working with those groups in this kind of unexplored territory?
Sure. And first I'll say, Aqsa, thank you for the shout out. We might have to take a page from your book and get an MOU going with Wyoming. Didn't realize that was available to us. So we're going to be right back on your heels there. Harris, to answer your question, since its inception, it's really been the priority of LabCFTC to explore more efficient ways for innovative firms to interact with the commission, right? And that means exactly to the point that Alan was mentioning, helping firms navigate compliance as they look to scale their new ideas, right? I'm particularly glad that you asked this question because we want to reiterate that the size of the fintech is irrelevant to LabCFTC. We gladly offer the same face time to small firms as we do with larger entities. And what's important to get across is that we prefer entities to view the lab as a stakeholder. We're here to offer a compliance perspective and help businesses of all sizes really get it right the first iteration rather than working through some costly retroactive correction. And so this is why we encourage, shameless plug coming, we encourage businesses to visit cftc.gov/LabCFTC so that you can register for office hours, which actually has been on the incline since COVID, because we've had a number of technical and philosophical discussions around fintech technology, particularly as it relates to some of the crimes that we've been seeing during coronavirus. So in addition to that, we've demonstrated some deliberate efforts to host conferences that are at no cost to attendees and open to the public with the goal of addressing regulatory issues and new developments in policy. We also host a technology advisory committee, and those meetings are open to the public as well, where we share the stage with the innovators who are leading in this space so that we can present on real-time relevant issues and the latest in digital assets. And those, again, at no cost to the firms who may already be stretched based on some investments in their innovation. And so the last thing I'll mention is that we're particularly proud of this concept that we developed called Meet the Regulators. And this is an idea where fintechs participate in one-on-one conversations with our sister agencies, all convened at our FinTech Forward conferences. And this means that a small business could hypothetically arrange a meeting with the CFTC, the SEC, OCC, the Reserve Board, all in one setting in one day. And I know that would be a tremendous value add to any firm that's looking to increase its breadth and depth with the regulators in an efficient manner.
Thank you. Thank you. And staying on this theme, Aqsa, of sort of speaking with other members of the industry and perhaps even more traditional members of the industry, and knowing that Bermuda has a robust set of regulations for its own financial services industry, how do you see crypto being fully and naturally integrated into that wider financial services market in jurisdictions like Bermuda?
Yeah, I think this industry is innately disruptive and was built on the premise of disrupting traditional financial services with an objective to provide better and cheaper financial services to as many as possible. It's definitely meant to be more inclusive. I don't believe that we'll be at a point where we'll be fully or naturally integrated, because while disruption is not necessarily a constant state, what is continuous is a disruptive mindset, right? So we're increasingly seeing in both the traditional and the crypto world this notion of a disruptive mindset. And we're seeing more and more business models targeting the institutional market. So it's important that our framework accommodates the entire spectrum from niche disruptive models to larger, more conventional models aimed at institutions. And I think this is really where that sandbox is further highlighted, right? A sandbox gives the opportunity to test disruptive models, validate solution viability, and potentially even scale. There are institutions that will aim to integrate the traditional financial services and crypto worlds because they recognize that while traditional financial services cannot be eradicated, they can definitely be expanded upon to allow for new market innovations, increase of operational efficiencies, and even imagine new methods of conducting business. And we're already seeing this type of coexistence and the emergence of new models that venture further into the world of financial services, like models that integrate traditional and crypto world, like the insurance and blockchain business models. And we've seen some of that in Bermuda already. And disruption isn't limited to businesses in the traditional financial services and crypto worlds, but rather includes the broader ecosystem within which it operates. So throughout these environment disruptions and innovation, it's required on part of the regulator to ensure the regulations and the accompanying guidance allow for newer models to emerge and grow while also maintaining that regulatory remit of protecting consumers, ensuring financial stability, and preventing financial crime. I think at the BMA, like within our fintech department, we view this as job number one. And this is the mindset that begets sandboxes, and it will probably be environments like sandboxes and innovation hubs that enable crypto to continuously and sustainably disrupt for newer market innovations to emerge.
Roger, let's go a little deeper into this from your perspective, please, and staying on this theme of how the traditional markets interact with the crypto markets. What are your thoughts on how traditional concepts within the financial services industry, know your customer and other duties with regard to clients, how would they coexist in a crypto world? And do you see them being applied to these standards being applied to the new markets, or where do you think that's going, Roger?
I do. That's effectively the challenge. So centralized exchanges in the U.S. and other countries are applying KYC rules now. Early days of crypto, no, but I think the answer is yes now, generally. There's a separate question, however, of how these standards are going to be applied in decentralized contexts and how people can draw lines around these. At one end, you have peer-to-peer exchanges that are actively administered by a centralized organization. At another end of the spectrum, you've got decentralized autonomous exchanges, i.e. DAOs, that are protocols designed to operate autonomously without human interaction after it's been launched, and how one applies KYC to those is still TBD. In the middle, you have companies that operate as a user interface, which effectively is a gateway between a user and a decentralized marketplace. Software solutions currently permit the first, i.e. the centralized exchanges, and the second, the middle, i.e. being the software company acting as a user face. There, it is possible to apply KYC, but there'll be challenges for the last. FinCEN and FATF have proposed rules for VASPs, virtual asset service providers, which includes exchanges and other intermediaries, to report transfers of crypto between other VASPs and unhosted wallets. These are the kind of things that where these traditional rules on KYC and information reporting on transfers of assets between institutions, they're being applied, and I think it's actually good for the ecosystem in general, because where the regulators feel more comfortable that they can have mechanisms to catch the bad actors, but allow normal commerce to occur between intermediaries. That's the kind of thing where there'll be more commerce, more institutional adoption, more entry into the ecosystem, which effectively that's the disruption that Aqsa was talking about.
Okay, and Aqsa, I'm going to come back to you. How do you see consumer protection and market access being balanced in the cryptocurrency sector as this regulations develop in that world?
Yeah, that's a great question, right? So this fine line is not unique to the cryptocurrency sector, and I really want to highlight that. We're currently seeing it played out in retail investing with the likes of meme stocks, whether And that affected both the traditional and crypto sector. And we saw that very recently. Our regulatory framework is risk-based, and based on that, companies are required to be prudent in their operations. So, for example, this broad obligation translates in consumer education on complex products, particularly those innovative products that are newly emerging, they don't exist previously in market, such that the customer understands the risks involved with the product in question, and the company has an understanding of the legal implications of running a global platform. We've also released some specific guidelines to ensure consumer protection. For example, for companies dealing with digital asset custody, we have the Digital Asset Custody Code of Practice that outlines measures for the safeguards custodians can take to ensure client assets are actually protected. And part of our remit is actually to help find a balance. Right, the financial services sector has to be regulated so that customers have access in a safe and stable manner. This is a process of continuously refining regulations and supervisory processes, monitoring the market, and making adjustments where necessary. You really have to be agile. And overall, whenever there's a bull market in digital assets, and we've seen that very recently with the likes of Bitcoin, some consumers are excited to find buying opportunities. We encourage these consumers to deal with prudentially regulated exchanges that have obligations like minimum capital, segregation of assets, risk management, and the like. We also encourage digital asset businesses to talk with regulators to understand the benefits of regulation, not only from the consumer perspective, but also from the perspective of their firm's stability and their ability to withstand risks. Right. So by protecting consumers, they understand that the benefits of consumer protection allow them to run a prudential and sustainable operation that has some oversight from the regulator, and that requires certain things like a compliance framework and risk management program to be in place that actually protects them as well.
Understood. And Shivon, same question to you on behalf of the U.S. regulator. How do you see consumer protection, market access, and how that works in the cryptocurrency space?
Yeah, and I would agree with my fellow panelists. I think the success and the coexistence of market protection and market access really dependent on risk-averse strategy that really looks at promoting proof of concept, tech sprints, innovation competitions, and sandboxing. And so while the government would never advocate for a drinking game, if you were drinking water, this would be the time that you picked up your glass, because we certainly could reiterate over and over that this opportunity to test the technology prior to launch or engaging with real-time consumers is really where the success lies, because you don't know what you don't know. And it's certainly, if you're looking to address specific industry challenges, this is the way to go. Thankfully, regulators are already actively taking a stance in this approach, right? Aside from the CFTC hosting a science prize competition that was open to innovators, we're really looking to aim and explore our redress list, locating unregistered entities. And we also know that the CFPB was hosting tech sprints and hackathons in 2020 to really uncover and test their e-disclosures and the delivery of the adverse action notices that they had. We also know the Federal Reserve Bank had released a statement in August of 2020 about how they're conducting in-house experiments by means of the board's technology lab. And they were testing a range of DLT platforms. And of course, we're familiar with what's going on in the UK, right? FCA was among the first regulators with a sandbox, which really allowed businesses to test innovative propositions in the market with real consumers. So to answer the question, the balance is absolutely achievable. We just have to infuse some lateral thinking unconventionally with some fresh perspective on how to move the needle.
Great. Now I'd like to turn to another topic. DeFi. And in our last 10 minutes, I'd like to get some thoughts on that. And Dan, Roger, I hope you don't mind if I call on you first. What are some of the issues that you're seeing to kick off the DeFi discussion?
Sorry, take myself off mute. So great topic. In short, getting into DeFi, putting in an asset, is that a taxable event? So am I going to trigger gain loss? My personal view is no, but it's TBD, because in effect, what you're doing is using an asset, for example, to create liquidity, to participate in a protocol to exchange it in other ways. Number two is, depending on the protocol, you may be getting fee income. But what is the nature of that fee income? Is it business income? Is it passive income? Where's the source of it? Could I be taxed in another jurisdiction? When I withdraw my asset, is in effect, do I have a new asset establishing my new basis associated with that? So I think these are some of the issues that in particular funds are having to deal with. Investment funds, if they're participating, how do they classify the income? When do they realize the income? If there's a lockup period, do they respect the lockup period for purposes of the timing of the income inclusion? Because obviously, given the volatility in crypto markets, a lockup period is meaningful. Again, my personal view is that you do respect the lockup period. The IRS recently issued some guidance on respecting the fact that one could not access one's crypto for purposes of saying you don't have dominion and control over it. So, and then you have to see the nuances, how all these factors play out based on the relevant protocol that you're participating in. You know, we in our software platform just launch support for more than 30 DeFi protocols. So we have to literally analyze these kinds of issues separately for each protocol that we get into.
Now, Alan, if you would talk to me a little bit about cash and the role of cash and cash settlements, particularly in light of emerging DeFi technology. Where do you see that going? What are some of the issues the industry might be facing, particularly in the regulatory regime of how the cash settlement process is handled?
Yeah, so two observations on that. One is from a payments perspective, and second one is from a security settlement perspective. On the payment side, when the Satoshi white paper came out 13 years ago, right, the word currency was in the title. And so the thought process around having easily accessible payments rails was the origin of what we're talking about. You know, it's a cryptocurrency, not crypto asset, although we talk about digital assets, you know, to mean a number of things now. And the effectiveness of these assets as cash is a topic that is very much under discussion, you know. And, you know, is it a function of tax that Roger talked about, that, you know, anytime I use Bitcoin to pay for a sandwich, it's a tax event? That's not a great thing. Is it a function of technology speed and what distributed networks can and can't support in terms of transactions that are written to them every second? Is it a function of gas or network fees that go along with writing to chain? Is it a function of acceptance, meaning where at the point of sale or service can you use cryptocurrencies? And although that's changing, and there's a number of private and public actors, including some municipal authorities, that are now accepting these types of instruments. And of course, there's a conversation about central bank digital currencies that goes beyond that. And maybe the acceptance conversation in terms of pushing out mass acceptance to merchants and other service providers is second stage if you can pay your Visa bill with cryptocurrency. So in which case you're really kind of a layer removed from point of sale or point of service acceptance. So that's kind of the first part of the cash discussion. The second part of the cash conversation is that until you have recourse to faster cash movements than what you have now, the promise of digital securities, in particular real-time or near real-time settlement, is very much subject to the cash leg of a settlement cycle that is in turn very much subject to traditional banking rails, particularly when you have to cross financial firms, whether inside a central clearing ecosystem or outside of it. And so a faster cash, whether it's private faster cash, so stable coins or other cryptocurrencies, or public faster cash, so central bank digital currencies, is a critical ingredient to making other things possible.
And thank you. And Aqsa, how about the BMA's thoughts on DeFi? Where do you see those issues going, and how is the BMA approaching it?
Yeah, I think the important point here to focus on is the degree of decentralization, right? So most models purport DeFi. However, when you look under the hood, there is still a central party that maintains control or is managing the code, et cetera. And the current state, like models themselves are not as decentralized as they may seem. That isn't to say that true DeFi models aren't emerging and will continue to work towards greater decentralization with time, but I don't actually believe we're currently there. From the Bermuda perspective, our regulations are broad and focused on the digital asset activities being conducted, regardless of the degree of decentralization or centralization for that matter. We have had conversations with several DeFi entities and are working with the nature of regulation that could apply to these entities or models. It definitely forces us to think harder about how do we accomplish our goals, right? So when evaluating DeFi models, generally we take a closer look at decentralized governance models and procedures, like how are decisions being made, due diligence for any third-party integration or oracles, handling of systems issues and complaints, how AML obligations can be implemented into the protocols. And ultimately, we want to ensure that even in a decentralized system, consumers and their rights and the broader financial system are still protected, right? So we're at a point where we're having these conversations with the market, and we're hoping that these enhanced conversations will further inform our approach.
Thank you. And I know we're getting very close here. There's a couple of more topics that I really want to cover. So I'm gonna go right back to Roger. Roger, do you see a place in the regulatory regime that we've been talking about for investigation, surveillance authority regarding the use of cryptocurrencies and illicit transactions? What does the industry see as a new, fresh regulatory role in connection with those investigation and surveillance type situations? Where do you see that fitting in?
So the point is that I think it's essential for regulators to be able to identify, detect illicit transactions and track them. They are engaging with a number of blockchain data attribution companies to do exactly that, and I think that's important. Having regulators to have the ability to detect and trace illicit transactions, in particular, like for example, the Colonial Pipeline hack, how they so quickly got that. If that were cash, I think we still wouldn't have resolution of that. The fact that blockchain data is immutable, pseudonymous, and they were able to trace using the blockchain data tools that they were able to is phenomenal. And then I think quite frankly, then the next step is from a global jurisdictional matter, from the regulators' perspective, how do you align with other jurisdictions so that it's not just one country, two countries, three countries doing this? The J5, which is comprised of five countries, not all of them are large, that are coordinating around criminal tax matters and other matters that's essential. And how do you broaden that kind of thing to make it very, very difficult for certain bad actors not to terrorize, quite frankly, if I can use that phrase, economies, companies, et cetera, with ransomware and things like that. So I think those things are essential.
Very good. And I know we're in our last minute. So what I would like to do now, what I like to do with panels that I work with is call for the lightning round. So I'm going to call on you, and I'd like you to identify what you see as the most important regulatory issue facing the digital asset cryptocurrency industry. And I would like to call on Alan first. If you could give us 10 or 15 seconds on your quick thought during this lightning round.
Yeah, absolutely. Look, we got to shift away from fringe behavior and shift away to the benefits and product design and move forward. After all, as Roger said, we found crypto a lot faster than we would have cash or bags of diamonds. And so we have to be focused on product design.
Shivon, your turn.
Yeah, listen, my bottom line is that America is still very attractive in a highly sought after market. And so both businesses, both domestic and globally, want to prevail in the digital asset space. They're going to want to work and access the US markets and its consumers. And so our aim as a regulator in this space is really just to foster responsible innovation that embraces technology in this area. And so it's important that we're working through open engagement and through education to facilitate that.
And Roger, your turn.
Reporting, striking the balance between what is meaningful reporting for regulators, clear rules about what must be reported, what kind of reporting is capable of being automated and doesn't require human interaction for follow-up, and applying that to the different verticals of regulating transactions, AML, KYC, and tax reporting.
And Aqsa, bring us home.
Thank you. I think the BMA's role is to regulate and supervise the industry, right? So if you only look at it from that angle, though, you risk stifling innovation. So we have to continually balance and rebalance our framework to make sure our regulatory framework is fit for purpose, both from the perspective of consumer protection and from the perspective of allowing new market innovations to occur, achieve consumer economic and social benefits, while also growing in a compliant manner. We want to make sure that we're pushing this industry forward.
Very good, and thank you so much. That is all the time we have, and given the composition of this panel, we're unable to take audience questions, but we went right up to the hour. We had a fascinating discussion. Thank you to my panel so much for participating in this very important discussion. I enjoyed it. I'm sure our attendees did as well. Thank you so much. But remember, the fun's not over yet. Even though the panels are done for the day, you still have the opportunity to engage in a relaxed but informative networking groups, meet with your colleagues, your peers, and other attendees of the conference, and say hello to our sponsors and the various sponsors networking rooms. I would encourage everyone to let's keep up this discussion, important stuff that we're talking about here. And I know we would all benefit from continuing this discussion both this evening as well as during the discussions tomorrow. So thank you. It's really been a pleasure hosting this panel. Thank you all. And I will sign off.